Disclaimer.
Something happened on December 26th, 2025 that should terrify every investor watching this video. While you were enjoying the day after Christmas, the Federal Reserve Bank of New York quietly injected $17 billion in emergency cash into our banking system. $17 billion in a single morning at 8 a.m. This wasn't a scheduled operation. This wasn't routine liquidity management. This was a financial fire alarm going off while the rest of America slept off their holiday meals. And here's what makes this absolutely critical. According to investigative journalist David K. Johnston's exclusive report published on December 29th, this emergency injection is directly connected to a catastrophic position in the silver market. A position so large, so underwater, that it required the Federal Reserve to step in with billions in backdoor support. The bank, JP Chase, the exposure, $13.7 billion. The metal causing all this chaos, silver. Let me show you exactly what's happening, why JP Morgan is trapped, and why the US government just realized we've lost control of one of the most critical industrial metals on Earth. Here are the facts. According to the Federal Reserve's own public data, repo operations, which are essentially emergency loans to banks using collateral, had been running near zero for years. Through most of 2024 and into 2025, these overnight facilities sat dormant. Banks didn't need them. Our system was stable. Then something changed. Starting in late October 2025, repo usage began climbing. By Halloween, tens of billions were being borrowed. By December, the outstanding balance exceeded $40 billion. And on December 26th, the day after Christmas, a single institution borrowed $17 billion in one transaction. Think about that timing. Christmas Day, a federal holiday, markets closed, and yet someone needed $17 billion so desperately that the Fed opened its emergency window at 8 a.m. the next morning. David K. Johnston, the Pulitzer Prize-winning investigative journalist who exposed this in his December 29th report, connected the dots. This wasn't about general market stress. This was about silver, specifically about a bank that made a catastrophically wrong bet on silver prices and is now facing an existential crisis. Here's where this story gets truly insane. For years, JP Chase was the most aggressive short seller in the silver market. They held a massive 200 million ounce short position, meaning they were betting silver prices would fall. They were so aggressive that they paid over $920 million in fines in 2020 for manipulating precious metals markets. This isn't conspiracy theory. This is documented federal court record. But something changed in 2024 and 2025. Silver didn't fall. It exploded. From January 2025 to December 2025, silver prices surged 144%. The metal that was trading around $23 per ounce in early 2024 broke through $50, then $60, then touched $86 before settling in the $70 to $80 range, where it trades today in January 2026. And JP Morgan? They didn't just get caught short. They panicked. They reversed their entire position. According to the most recent COMEX delivery data from January 2026, JP Morgan went from holding a 200 million ounce short position to holding a 750 million ounce long position. They went from betting against silver to desperately trying to acquire physical metal. They flipped from the largest short to the largest long in recorded history. But here's the problem. There is not enough tradable silver in the world to close out a position that size. Johnston's analysis, published in his DCR report exclusive, calculates JP Morgan's exposure at $13.7 billion. That's roughly equivalent to JP Morgan's profits every 90 days. One bad quarter, one wrong move. And a bank that survived 2008 could face a liquidity crisis over a metal most people think is just for jewelry. Now, let me show you why the situation just became exponentially worse. On January 1st, 2026, just 6 days ago, China activated new export licensing restrictions on silver. These restrictions, announced through the Ministry of Commerce in late 2025, limit refined silver exports to just 44 authorized companies. 44 companies, controlling approximately 121 million ounces of annual exports. That represents 60 to 70% of all refined silver traded globally. China didn't ban silver exports. They did something smarter. They created a bottleneck, a choke point. And here's the truly insane part. China exported over 4,000 tons of silver in the first 11 months of 2025, while importing only 220 tons. They're a net exporter. They have the supply. But now they control who gets it, when they get it, and at what price. The Shanghai silver premium, the amount Chinese buyers are paying above COMEX prices, is currently running $8 to $10 per ounce. That's not a small arbitrage opportunity. That's a massive pricing dislocation that's pulling physical metal out of Western vaults and into Chinese warehouses. Even Elon Musk weighed in. On December 27th, he posted on X criticizing the export restrictions, noting silver's essential role in industrial processes. When the richest man in the world is publicly concerned about silver supply chains, you know something fundamental has broken. So let's put this all together. JP Morgan holds 750 million ounces of long exposure in a market where global annual mine production is only 835 million ounces. They need physical metal to close their position. But China just locked down 60 to 70% of refined supply. And the Fed just injected $17 billion in emergency liquidity on December 26th to an unnamed bank facing a collateral stress. Do you see the trap? JP Morgan can't exit without causing silver prices to spike even higher. They can't secure physical delivery because China controls the supply. And they can't hold the position forever because the carrying costs on 750 million ounces of futures contracts is bleeding them dry. The Fed knows it. JP Morgan knows it. And now China knows it. This isn't a normal market correction. This is a financial institution trapped in a position they mathematically cannot escape, in a metal the United States desperately needs but no longer controls. And that $17 billion Christmas bailout? That's just the opening move. Let me show you the evidence that proves this isn't just another market story. This is a systemic breakdown in one of the most important industrial metals on the planet, and the United States government just realized we were completely unprepared. On December 10th, 2025, 16 days before that $17 billion emergency injection, the Federal Reserve made a policy change that should have made headlines everywhere. They removed the aggregate operational limit on their standing repo facility. Read that again. They removed the limit. No cap, no ceiling. Unlimited cash available through overnight operations. For those who don't follow Fed policy closely, let me translate. This is what central banks do when they are preparing for a financial institution to implode. This is the emergency lever you pull when you know something is about to break, but you can't tell the public yet because it would cause a panic. The last time the Fed offered unlimited repo operations was March 2020 during the COVID market crash. Before that, September 2019 during the repo crisis that foreshadowed the pandemic. And before that, 2008. Unlimited repo isn't something the Fed does casually. It's the financial equivalent of a fire department positioning trucks outside a building they know is about to catch fire. Now combine that December 10th policy change with the December 26th injection. The Fed saw this coming. They knew a major institution needed a backstop, and they made sure the plumbing was in place before the crisis hit. But here's what makes this particularly damning. The timing coincides exactly with silver's price movements and China's export restriction announcements. Silver hit its 2025 high of $86.41 per ounce on December 18th, 8 days after the Fed's policy change. It then corrected to the mid-70s by Christmas. That correction? That's when someone got margin calls. That's when someone needed $17 billion in emergency liquidity just to meet collateral requirements. Now let me show you something that proves this crisis is about physical metal, not paper speculation. In October 2025, the silver market entered a rare condition called backwardation. This is when near-term futures contracts trade at higher prices than longer-dated contracts. In normal commodity markets, this relationship is inverted. You pay a premium for contracts further out because you're essentially paying for storage and time. But backwardation signals something critical. The market values physical metal in hand more than the promise of future delivery. Silver hasn't been in sustained backwardation since 2021. The fact that it entered backwardation in October 2025, just as JP Morgan was aggressively standing for physical delivery, tells you everything you need to know about supply conditions. The paper market says there's plenty of silver. You can trade millions of ounces with the click of a button. But the physical market? The physical market is screaming that metal is scarce, delivery is uncertain, and anyone who actually needs the metal better pay up. The COMEX reported inventories tell the same story. Registered silver, the metal actually available for delivery, has dropped to levels not seen since 2015. We're talking about less than 80 million ounces of registered inventory to back up billions of ounces of paper claims. That's a leverage ratio that would make any risk manager break out in a cold sweat. And here's where JP Morgan's position becomes truly catastrophic. They're trying to secure physical delivery in a market where the ratio of paper claims to actual metal is somewhere between 100 to 1 and 250 to 1, depending on whose analysis you trust. On November 7th, 2025, the U.S. Geological Survey finalized the 2025 critical minerals list. This list, compiled by the Department of the Interior, identifies mineral commodities essential to U.S. economic and national security that face supply chain vulnerabilities. Silver made the list for the first time. Think about what that means. For decades, the U.S. government classified silver primarily as a precious metal, something for investment, jewelry, maybe some minor industrial uses. But in November 2025, they officially reclassified it as a critical mineral, alongside lithium, cobalt, rare earth elements, and uranium. The designation isn't symbolic. It unlocks specific federal authorities, access to Defense Production Act funding, expedited permitting for domestic mining projects, eligibility for Department of Energy, loan guarantees, priority access to the National Defense Stockpile. Here's the official language from the USGS report. Silver is used in electrical circuits, batteries, solar cells, and antibacterial medical instruments. That's our government acknowledging what the markets already knew. Silver isn't optional. It's embedded in every advanced technology the U.S. military and industrial base depends on. But here's the truly damning part. Despite adding silver to the critical minerals list, despite allocating $7 billion total for critical minerals programs, despite taking equity stakes in lithium and copper mining companies, the U.S. government has allocated precisely $0 specifically for silver stockpiling. Let me repeat that. $0. The One Big Beautiful Bill Act, passed in early 2025, allocated $2 billion for the National Defense Stockpile, and $5 billion for the Department of Defense's Industrial Base Fund to invest in critical mineral supply chains. Know what metals they prioritized? Lithium, rare earths, copper, uranium, antimony, silver? Not mentioned once in the funding priorities. This is insane. The U.S. uses approximately 35 million ounces of silver annually just for defense applications, missile guidance systems, radar, electronic warfare, naval systems, you name it. Every Patriot missile uses silver. Every F-35 uses silver. Every Virginia-class submarine uses silver. And the U.S. has no strategic silver stockpile. None. The last confirmed silver in the National Defense Stockpile was sold off in 2002. Meanwhile, China added silver to its rare earth export control list on January 1st, 2026. They have a stockpile. They have control. They have leverage. The U.S.? We just realized we outsourced our entire industrial silver supply chain to the one country we're trying to decouple from. Let me give you some specific examples that prove how critical this situation has become. The AIM-9X Sidewinder missile, the air-to-air missile that's a cornerstone of U.S. air superiority, uses silver in its guidance system wiring, electrical contacts, and circuit boards. Why? Because silver has the highest electrical conductivity of any metal. You can't substitute it without degrading performance. The AN Spyway-6 radar system, which is being installed on every new Arleigh Burke-class destroyer, uses silver-coated waveguides and RF components. Again, not optional. Silver's high-frequency performance characteristics are unmatched. The Aegis combat system, which protects our carrier strike groups from ballistic missile threats, relies on silver in its signal processing, power distribution, and electromagnetic shielding. These aren't luxury items. These are weapon systems currently in production. And according to defense industry analysis published in July 2025, the One Big Beautiful Bill Act authorized over $25 billion in silver-reliant defense projects without securing any of the actual silver needed to build them. Let me quote directly from that analysis. With more than $25 billion in silver-reliant projects in this one bill alone, there's an uncomfortable truth no one seems eager to confront. We are planning a defense strategy with metal we may not be able to source. The same report notes, the U.S. is charging forward into an electrified, autonomous, AI-enabled future. But until someone takes silver supply seriously, even the most beautiful bill might be building ships that can't be wired, weapons that can't be fired, and systems that can't be powered. This isn't the first time a major institution has gotten trapped in the silver market, but the scale is unprecedented. In 1980, the Hunt brothers tried to corner the silver market with approximately 200 million ounces. The COMEX changed the rules mid-game, implemented position limits, and the Hunts were forced to liquidate. Silver crashed from $50 to $10. The Hunts went bankrupt. But here's the difference. JP Morgan isn't some reckless billionaires making a speculative play. They're a systemically important financial institution with $3.2 trillion in assets. They're one of 5 U.S. banks designated as too big to fail. And they're not trying to corner the market. They're trying to escape a position they can't mathematically exit. The Hunt brothers had to sell. JP Morgan needs to buy. And China just made sure there's no one to buy from. So where does this leave us in January 2026? Silver is trading in the $70 to $80 range after peaking at $86. That's still up 144% from January 2025. COMEX registered inventories continue falling. Shanghai premiums remain elevated at $8 to $10 per ounce. China's export restrictions are now in full effect. And JP Morgan? They're still sitting on 750 million ounces of long exposure with no clear exit strategy. The Fed gave them $17 billion on December 26th to meet immediate collateral calls. But that's not a solution. That's a Band-Aid on a hemorrhaging wound. Because every day silver stays above $70, JP Morgan bleeds. Every day China restricts supply, the news tightens. Every day the Fed props them up, the systemic risk grows. This is 2008 all over again, except instead of mortgage-backed securities, the toxic asset is a metal most people don't even realize is critical. Now, let me show you where this is heading. The mathematics are inescapable, the timeline is specific, and the consequences are catastrophic. Here are the numbers that Wall Street doesn't want you to focus on. Global silver mine production in 2025, 835 million ounces. Global silver demand in 2025, 930 million ounces. That's a deficit of 95 million ounces in a single year, but it gets worse. This is the 5th consecutive year of structural deficit. When you add up the shortfalls from 2021 through 2025, the cumulative deficit is 820 million ounces. That's nearly equivalent to one entire year of global mine production, simply gone from above-ground inventories. Where did it go? Solar panels, electric vehicles, electronics, industrial applications. And yes, investment demand from people who realized the supply-demand imbalance was unsustainable. The Silver Institute forecasts another deficit in 2026. Major banks agree. This isn't a temporary squeeze. This is a structural imbalance that gets worse every year because, 1. Silver is primarily mined as a byproduct. Only about 29% of silver comes from primary silver mines. The rest comes from lead, zinc, copper, and gold operations. You can't just mine more silver without also mining more of those base metals, and those markets have their own supply-demand dynamics. 2. Ore grades are declining at mature operations. Mexico, Peru, China, the top producing countries, are all seeing grade degradation. You have to process more ore to get the same amount of silver. 3. Permitting timelines for new mines now exceed 10 to 15 years in most developed countries. Even if you wanted to bring new primary silver production online, you're looking at 2035 before meaningful new supply hits the market. So the 820 million ounce deficit that's already been drawn down from inventories, that metal is gone. It's in solar panels on rooftops across China. It's in circuit boards and warehouses waiting to be assembled. It's in ETF vaults where investors are holding physical metal. And JP Morgan needs 750 million ounces. Do you see the problem? Now, let me give you a specific date that could trigger the next phase of this crisis. January 9th, 2026. That's this Thursday. The Bloomberg Commodity Index, one of the largest commodity benchmarks tracked by institutional investors, is conducting its annual rebalancing. Silver's weight in the index is being reduced from approximately 6% to just under 4%. That sounds technical and boring, but here's what it actually means. Funds tracking this index must sell approximately $5 billion in silver futures over a 5-day period, starting January 9th. $5 billion in 1 week. TD Securities, one of the major banks tracking commodity flows, published a note on January 3rd stating, "We expect a massive 13% of aggregate open interest in COMEX silver markets will be sold over the coming 2 weeks to result in a dramatic repricing lower." They're predicting a price crash, and they might be right in the short term. But here's what makes this absolutely critical. If silver crashes, JP Morgan's collateral value crashes with it. Remember, they're holding 750 million ounces of long exposure. A $10 drop in silver prices costs them $7.5 billion in mark-to-market losses. That's why the Fed gave them $17 billion on December 26th. They knew this rebalancing was coming. They knew JP Morgan would need a cushion to survive the volatility. But what happens if the selling triggers a cascade? What happens if other banks with silver exposure also face margin calls? What happens if the paper market selling creates an even bigger disconnect with the physical market, where supply is genuinely scarce? You get a situation where silver could simultaneously crash on paper while physical premiums spike even higher. You get a market that literally breaks, and that's when things get truly dangerous. Here's where the smart money is positioning for 2026. Citigroup, in their December 2025 commodities outlook, stated silver will continue to outperform gold and projected prices in the high 70s for 2026. Bank of America raised their 12-month silver target to $65, calling it a conservative estimate given supply constraints. UBS forecasts silver to average $57 in 2026, with potential runs towards $60 later in the year. But those are the conservative calls. The really bullish analysts, the ones looking at the same supply deficit data we just walked through, are calling for much higher. Frank Holmes of U.S. Global Investors told Investors News Network, "I think that silver will be over $100. Felipe Geisels, Chief Strategy Officer at BNP Paribas Fortis, told CNBC he would not be surprised to see silver well north of $100 in the not-too-distant future. And veteran technical analyst Michael Oliver, who correctly predicted silver's 2020 rally, has suggested a scenario of $100 to $200 silver by early to mid-2026. Why such wide variance? Because no one knows what happens when a major bank is trapped in a position this size during a legitimate supply crisis. In a normal market, you could model price targets based on supply-demand fundamentals. But this isn't a normal market. This is a market where one institution holds more long exposure than the entire U.S. annual production, where China controls 70% of refined supply and just weaponized that control, where the Fed is already providing emergency liquidity. The price targets aren't about fundamentals anymore. They're about how high silver has to go before someone breaks. Let me walk you through the 3 ways this resolves, and why 2 of them are catastrophic. Scenario 1, the controlled crash. Silver selling from the Bloomberg rebalancing drives prices down to the $50 to $60 range. JP Morgan takes massive mark-to-market losses, but survives with Fed support. Physical premiums spike even higher as the paper-physical disconnect widens. China buys the dip. Western investors panic sell. Silver slowly bleeds lower through Q1 2026. Probability 30%. Why it's unlikely? This requires China to cooperate by releasing supply, the Fed to continue unlimited support, and no other major banks to have silver exposure. Too many things have to go right. Scenario 2, the short squeeze. The rebalancing selling triggers the crash everyone expects. Silver drops to $60, but then physical delivery demands overwhelm COMEX inventories. Someone, maybe JP Morgan, maybe another bank, fails to deliver on their contracts. COMEX either changes the rules like they did to the Hunt brothers, or prices explode higher as longs demand physical settlement. Silver spikes to $100 to $150 in a matter of weeks. Probability 40%. Why it's likely? The physical shortage is real. China's export restrictions are binding. JP Morgan can't be the only institution caught wrong. When one link in the chain breaks, the whole system fails. Scenario 3, the government intervention. The Fed, Treasury, and CFTC convene emergency meetings before January 9th. They force a settlement. JP Morgan is allowed to cash settle their long position at a predetermined price. COMEX changes position limit rules retroactively. China is offered trade concessions to release silver exports. The crisis is managed. Probability 30%. Why it's possible? Governments hate letting markets break in full public view. They'll do everything possible to contain this behind closed doors. But this requires China to play along, and China has no incentive to help. Here's what you need to watch in the next 2 weeks. If silver drops below $60 during the rebalancing, but Shanghai premiums spike above $15 per ounce, that's the signal that physical shortages are overwhelming paper selling. If the Fed conducts another large repo operation above $10 billion between January 9th and 16th, that means another institution is in trouble. If China announces any changes to their export licensing, either tightening or loosening, that's Beijing signaling their next move. And most importantly, if you see any headlines about COMEX changing margin requirements again or modifying delivery rules, that means they're preparing for a default. Let me bring this back to where we started. On December 26, 2025, the Federal Reserve injected $17 billion into our banking system to keep a major institution solvent through a silver market crisis. That institution, based on all available evidence, is JP Morgan Chase, holding a 750 million ounce long position they cannot exit. China controls 70% of refined silver supply and just locked it down behind export licenses. The United States added silver to our critical minerals list, but allocated $0 for stockpiling. And starting January 9th, $5 billion in forced selling could trigger the exact volatility that makes this entire situation collapse. This isn't speculation. This is mathematical reality. JP Morgan cannot close their position without spiking prices. They cannot secure physical delivery without China's cooperation. And they cannot hold indefinitely without Fed support. The Fed bought them a few weeks with that $17 billion. But every day this position remains open. The systemic risk grows. Silver isn't just a precious metal anymore. It's a systemic threat to financial stability. And no one in power wants to admit we've lost control. The only question now is whether this breaks in public view or gets managed behind closed doors. But either way, it's breaking. Watch January 9th.